Hello everyone, I'm AJ Cradfield, Managing Member at Vital Wealth Management. Thank you for attending today's webinar. There's a lot to say, so let's jump in. Topics for today will include the U.S. economic growth, or GDP, inflation, bonds and the Fed policy, as well as the U.S. stock market. Let's take a look at the U.S. economy here. The blue trend growth line of 2% since 2001 has been the average performance of the U.S. economy. And you can see that as of here recently, we have a little blip down in regards to our GDP being down 1.4% in the first quarter of 2022. But if you take a look at the fourth quarter, we grew at 6.9, 2.3 in the third quarter, and 6.7 a year ago. So the economy is cooling naturally. And the question here is this a blip, or will we head back to trend growth? It's yet to be determined, but something that we're looking at this time. 5% of GDP tends to come from housing. About 14% comes from the investment ex housing. 17% comes from government spending. 68% comes from the consumer. That's all of us spending money, which creates other people's income. And we actually import more than we export as a country, hence having a negative export reduce part of GDP. So let's take a look at where growth might come in the coming quarters. The Atlanta Federal Reserve does a great job at predicting future growth, and their guess is that the second quarter could come in at about 1.8% growth. If we take a range of the top 10 and bottom 10 average forecast, it looks more like 3% at this time. So many people are assuming that economic growth will pick up here in the second quarter, and that would be good news for the stock market. Take a look here at the Cleveland Fed statistic. This gives us an idea of the probability of recession as calculated by the yield curve. So here what we're trying to do is take the 10-year Treasury minus the 3-month Treasury, and it gives us a current probability of only 2.7% chance of a recession. I would take this with a grain of salt, just with the idea that the Fed is going to do a lot of interest rate hikes here in the coming months that could really change this statistic drastically. But with that being said, we never really had a recession while the Fed was just starting to raise interest rates. I'll talk about that here in a second. But in general, you tend to see this blue line spike before a recession. The blue line is the probability of a recession here, and the gray bar is an actual recession. So you'll tend to see that in history, we tend to see the blue line come up and then a gray bar down, blue line up, gray bar down, blue line up, gray bar down. There are some, false positives here where recession probability did go up, but actually cooled back down without a recession. And this happened a couple of times in the 90s and back in the 60s. So there's a chance that the Fed could raise rates and we wouldn't go into a recession. We shall see. Let's talk a little bit about inflation now. The dollar store has become the $10 store. We do know that Dollar General changed their prices here in December from $1 to $1.25, and that's the idea here, is that inflation is impacting all goods that people are buying. So let's take a look at inflation here and take a look at headline CPI. This is the measurement that I like to look at. It includes food and gas. For those of us that eat and drive, which I would think is most of us, the Fed actually looks at a core level of that, so they strip out food and gas in regards to their inflation metric. The 50-year average is about 4%. As of March, it was at 8.6, so double the long-term average. CPI for April that came out yesterday on May 11th was 8.3%. So this is unseasonably high, and it's caused interest rates to move higher, and it's caused people to revalue the valuation that they'll put on stocks moving forward. So it is important to note that, coming in with the pandemic, we saw inflation really low, almost down to the zero spot here, and inflation has really pivoted to a higher level. And the question is, will it keep going? Will it sustain here, or will it cool off? And if it cools off, I think that's going to be great news for stock and bond markets. Maybe it's wishful thinking, but I'm going to stay on the positive side here and think that we might have seen potentially the highest inflation rate so far. Let's talk about the contributors of inflation. And what I really like about this graph is it gives you an idea of back last March, we had 2.6% inflation, and it's really hard to remember that. But right now we're at 8.3, and as of last March, or March of 2022, we're at 8.5. What I really like about the way that this graph is comprised is it shows us the different metrics that make up the 8.3%. So energy obviously has been a big contributor, going, increasing dramatically. New and used vehicles has grown a lot, but it's also cooled off here more recently from an inflationary perspective. Food at home, these three things can possibly be transitory. Then you've got other restaurants at hotels and shelter. These are rents. So you can see that pretty much every measurement of inflation has really gone higher here. The question is, how will it stick moving forward? Personal savings rate. This is the personal savings rate of the average American. It's at 6.2%, and it spiked, as you can see here, during the first COVID lockdowns. People couldn't spend money, and they got stimulus checks along the way, and then they spent that money on goods, and they got a double stimulus, and they spent that money. So if there's an optimism here, it might be that the consumer is back to their normal savings rate, and potentially there'll be less goods being purchased that will cool down inflation a little bit, but hopefully still enough growth to grow the economy. So this has actually been the worst ever start of a year for bonds. If we take a look at the Barclays aggregate bond market, we're down 9.5% in the Barclays aggregate bond index year to date, and the worst ever start of the year. Now let's take a look at what this might tell us about the next 8 to 12 months. The next 8 months historically, after seeing a downturn, has been somewhere between 5 and 7% rate of return on average, looking at the 10 worst starts of the year for bonds since 1926. So we're optimistic here that these higher rates could insulate future returns, and the prices have already been damaged, and that moving forward, bonds could provide that ballast that they have historically for clients and investors. The big reason why we're seeing interest rates rise has been the biggest reason why we've seen bond prices fall, and the 10-year Treasury here has gone, as of December of 2021, from 1.5% all the way up to May 6th to 3.1. So you get this idea here that the yield curve, this is the curve in which you had different maturities at different interest rates out December of 31st of 2021. Every interest rate on the yield curve has gone up pretty dramatically. So there's a very flattening yield curve here, and you can kind of see that the Federal Reserve or the bond market has front-run the Federal Reserve's thought process on raising rates. So the Fed talked about raising rates 8 to 10 times, and here you go. You've got the 2-year bond at 2.7%. So the bond market is priced in what the Fed could do, and so the thought process here is that the damage might be done already, and that from here moving forward, you should get a better return on your bonds moving forward. What I also like to look at here is the yield range over the last 10 years. So you can see that historically, we haven't gotten a lot higher than this. I mean, this time could be different, but historically, this has been about the high that we've gotten in regards to interest rates in the short end at 5 or 7 years into 3 months. So the Fed will be raising rates continuously, and we'll see what they do, but they'll probably stop right in this area, the 2.25% to 2.5%, and take a deep breath and see how the economy and the markets are performing at that time. But this is the big reason why bonds have sold off. As interest rates rise, prices fall, but it also means that your future return will be greater because the interest rate will be higher. So as I was speaking to earlier, as the Fed raises rates, a lot of times they'll raise rates into a recession. Again, you'll see a recession in the gray bar. And right now the Fed is just getting off of zero. We've never had a recession where the Fed was just starting to raise rates. That's one reason why I'm optimistic we could potentially skirt a recession here and hang the course and invest in your stocks, and there could be a nice comeback if we don't go into a recession. Maybe there could be the odds of a recession could be higher moving out into 2023 or 2024. We shall see, but ultimately, interest rates haven't even barely moved up. So it'd be hard to think that the economy already fell into a recession without the Fed kind of raising interest rates and cooling off the economy into one. This is the Fed's balance sheet. Just briefly want to talk about the idea of the runoff of the bond balance sheet of the Fed. We have almost $9 trillion in assets as of May 5th. And you can see that back in the great financial crisis, we went from $1 trillion to $2 trillion on the Fed's balance sheet, and ultimately have pretty much grown the balance sheet throughout, except for this small period here in 2018 where the Fed did let some of the balance sheet roll off and sell off, and that didn't last for long. They purchased bonds back, and in the pandemic, they purchased a boatload of bonds, and they've been buying bonds ever since the low of March 24th in the marketplace, in the stock market of 2020, and they just stopped that bond buying program in March of 2022. So this is why many people believe, and it's true, that the Fed's behind the curve on inflation, because they've been pretty much in a stimulative, easy monetary policy stance for most of 2021, as inflation has gone from 2.6 to over 8%. The U.S. stock market, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. This is a quote by Benjamin Graham. He is the teacher of Warren Buffett, and it's always good to remember in times like these. So how have markets performed this year? Well, as of 2022, the major performance of major indexes through May 11th, we see the Russell 2000 or small cap stocks are down 23%. The emerging market stocks are down about 18.8% on average. The international developed MSCI EAFE down 16.9%. We've got the S&P 500 down right around 17%. And the high yield bond index, junk bonds, are down 10.4%. And quality, Barclays aggregate bond index, is down 9.48%. It's been a real rough year for all investments. It's very odd to see quality bonds sell off almost 10% while stocks are down 17%. It's really not taken place many times in the history of the market. So, I want to talk about stocks a bit here, and just how I don't think this is a bubble. As of May 11th, we have a price level of 3,935 in the S&P. We're trading at a valuation of 16.6 moving forward. What does that mean? It's the price of a stock, or the price of the index, divided by the earnings and the expected earnings in the next 12 months. And we're trading at a 16.6 multiple. What that also means is that you're paying $16 today for $1 of future profits from these companies. So we'll talk more about profits and valuations here in a second. But I just want to talk a little bit about how, going back to 2020, at the high watermark of the S&P, we saw 3,386. We were trading at 19.2 times forward earnings. And that gives you an idea that even though the market is trading higher than it was in February 19th of 2020, it's actually cheaper, hence the idea that earnings, if they do come in where they're projected to come in, you're buying them at a much lower multiple. And if you go back all the way back into like March of 2000, you'll see that while the index was 1,527 at the time, there was 25.2 times forward earnings. So you were paying a lot of money for $1 of earnings, and ultimately, the more money you pay for a dollar of earnings, tend to see a little bit less of a return in the future. Profits grew at 5.4% for the first quarter of 2022. So as you'll see here, the earnings per share of companies in the S&P 500, this is the blue line, is the consensus estimate. Again, we don't know for sure this will occur, but this is what the analysts are expecting. You will see here that the green bars are earnings recessions. This is the idea that earnings would have fell in 2020, hence due to the pandemic, but they bounced back very quickly to a really nice growth rate in 2021. The question is, where will they go from here? So if we take a look here of the percentage change in the S&P 500, looking at earnings growth and multiple growth, it tells a story that earnings for the first quarter were actually, or profits for the first quarter were actually up 5.4%. It's really the multiple. For, the marketplace has decided that it wants to pay a lower multiple for stocks moving forward based on inflation being potentially stickier and interest rates rising. And the reason we have a down 17% S&P 500 isn't because earnings aren't growing. although they are slowing, the multiple growth, people have decided, that stocks are overvalued and they need to be valued at a lower rate. So let's talk about what that multiple rate looks like. Well, if we take a look at the forward PE ratio, this goes back to 1997. You can see that depending on the year and the situation, investors feel like they can spend more on for a dollar of future earnings. They spend up to 24, 25 back in the late 90s. Obviously, that was the tech bubble and people, were spending a lot for future earnings. And then it also, on the opposite side, gets very low. In 2008, 2009, people paid as low as 10 times for future earnings. And the 25-year average is 16.85. And as of May 11th, we're at 16.63. So we're really right at just under the 25-year average for the future valuation of the S&P. So I'm hopeful that, that this does tell us something, that yes, stocks were trading at higher multiples. We also had lower inflation, lower interest rates back in this standpoint. But moving forward, I think we're back to kind of average multiples, and we'll see how the market decides to move from here. Annual returns and intra-year decline. So, what I really like about this chart is it tells a story that most of the time the stock market's positive. So in 32 of 42 years since 1980, we've seen the stock market rise 76% of the time. There are those times, nothing's forever, and there are times where we see the market fall. Like, for example, in 2020, we saw a 34% decline in the S&P, and it actually finished up 16%. Year to date, we're actually down 17% is the low, and we'll see where we finish up. But this gives you an idea that the average intra-year drop since 1980 has been about 14%. So the question here is, are we just at a normal correction territory, or is there something bigger like a recession? Are we headed down lower? We don't know anything for sure, and it's hard to kind of judge at this point, but it does give you some idea that, market volatility is not anything new. This is something that we tend to see over time, although this year's volatility has been, I think abnormally high, the highest since 2020. I really like to look at investor sentiment. This is investor sentiment reading from the AAII. This is the American Association of Individual Investors, and what they look at is that they'll pool and survey 1,000 individuals who have $1 million net worth or more as to, in the next 6 months, are they bullish on the stock market, bearish, or neutral? And a couple things show up here. On April 13th, only 15% of respondents were bullish on the stock market. That's one of the lowest readings going back into the early 90s, 1992. So when investors are that bearish, or there's a lack of bulls, that tends to be around the capitulation where most investors have sold, and maybe there's the chance of a relief rally in stocks, that things have gotten oversold. And if we take a look here, it has improved a little bit, but what you also see is that the number of bears, 59.4%, this is a one-year high in people that are bearish on the stock market. So let's take a look at an article from the AAII on what this might mean moving forward. So in an article from April 28th titled AAII Sentiment Survey, Highest Level of Pessimism Since March of 2009, historically the S&P 500 index has gone on to realize above average and above median returns during the 6 and 12-month periods following unusually low readings for bullish sentiment. So that's exactly what I was just speaking to. Low bullish sentiment tends to be a good 6 to 12-month reading moving forward in stocks. Unusually high bearish sentiment readings historically have also been followed by above average and above median 6-month returns in the S&P 500. I'm a big fan of this chart. It's the Ned Davis Research S&P 500 cycle composite for 2022. So it's kind of a complex chart. So the blue line here is what Ned Davis believes history tells us the market might perform at this year, and I'll explain more. The orange dotted line is the actual S&P 500 performance year to date. So you can see we're trading down here, down 17%. It's a little lower than what Ned Davis had maybe originally thought we might be down. But you get this idea that the cycle composite charts are designed to provide perspective on how repetitive historical market patterns could indicate a potential pattern for the current year. So they look at three things. They look at the annual cycle. So historically, how has the stock market performed on average? They look at the 4-year cycle. This is reflecting the time frame of a U.S. president. So they're looking at that midterm election kind of year, second presidential year, of the term. And they're looking at the 10-year decennial cycle, which it would be any year ending in 2. So you start with 2022, you look at 2012, 2002, and so on back in history. So you get this idea that over an annual, a 10-year, or a 4-year presidential cycle, and you equally weight them to get a consensus as to where we might finish. And it tends to have significant repetitive tendencies over history. So as you'll kind of notice here, they thought we might bottom out here this summer and have a nice rally, as well as have a very good end of the year with the midterm elections. That's how markets tend to act historically, and it gives me hope that there's still some good things to come in the stock market for those who stay with it. So let's take a look here. It's been the 3rd worst start of the year ever in stocks. So if we take a look back, in 2022 here, we're down 13% in the first 4 months. There's only 2 worse years, 1932 and 1939. Both had positive returns from here, up 14 and up 18. So again, there is hope that just because you start out down 13% doesn't mean you have to finish there. And what we'll see here is that the mean downturn in the worst 4 months of the year for stocks has tended to been around 11.9, and we finished up about 11.5 the rest of the year, or the median down 9.6 and finished up 13.7. So 66.7% of the time we were positive from here over the remaining end of the year. And again, it gives me optimism that we have a little bit of history on our side for a rebound in stocks. I like this graph as well. This gives you a real sense of history, bulls versus bears, bull markets obviously being positive returns and bear markets being negative returns. You can get a sense to why I tend to be bullish a lot more than bearish. And it's this idea that you see a lot more of the light green here than the darker green. And the concept being that, bull markets last a lot longer than bear markets. But when bear markets come, they tend to be very brief, maybe 12, 13, 1 month even, like COVID. And you go down anywhere from, 27%, 31%, 34%. But there's definitely a chance for a significant downturn if we do go into a bear market. But just remember that there's really no proven way to time the stock market. So the cost of trying to time the market, if we take a look at $1,000 invested in 1990 through 2020 in the S&P 500, if that investment performed at $20,451 throughout its time period of 1990 to 2020. If you then take a look and take out the best performing day, it performed at 18,329, minus the best 5 days, 12,917. Subtract out the best 15 days, and you're down to 7,080. And subtract the 25 best days, and you're down to 4,376. So timing the market is very, very hard. And when do these best days tend to occur? Well, they tend to occur around the worst days. So look at this graph. The 3 worst days in the history since 1950 of the stock market were March 16th, March 12th, and March 9th. You'll see it right here on the left. The 5 best days since 1950 were March 24th, March 13th, March 26th, March 17th, and April 6th. So really in the same year, in the same month, you saw the 5 best days and the 3 worst days. And then in the pink here, you'll see that over the last 20 years, 24 of the 25 best days in the market occurred within 1 month of one of the 25 worst days. So as we've seen this tremendous volatility to the downside, these stats make me hold stocks even longer and even potentially buy more depending on your situation, just because there should be a very nice comeback. I don't know when, but if history repeats here, there's opportunities by holding your stocks. If we take a look too, the best days tend to come after the worst. Again, just looking at it from a broader sense of view here, history shows that stock gains can add up after big declines. So if we take a look on the left, you'll see that if there's a 10% decline in markets, 1 year later, you tend to see about a 12.5% increase in stock price. And a 3-year average, it's more like 34.5%. And then on a 5-year average, you look more like 68.8%. 20% market declines have more like a 22% annual average cumulative return, with a 41% return in 3 years and 71% in 5 years. And if you do get a 30% market decline, you tend to have that snapback where 1 year later, you're up 23.8%. So as dicey and as crazy as markets might get to this point, if they do fall further, again, history's on your side that you have the chance to make this up quicker than you might think by hanging in there. One of the worst things you could do would be to sell, lock in a loss, and maybe go to cash or an investment that has no chance of growth, because we just can't time the market. I just want to finish with, in times like these, I like to focus on great long-term investors, and Warren Buffett comes to mind. I was born in 1979, and he said this quote to Forbes when I was probably 2 months old. But uncertainty actually is the friend of the buyer of long-term values. And I just have to think there's a lot of uncertainty out there right now, whether it's interest rates, Fed policy, are we in a recession, where are earnings going to come in at, the Russia-Ukraine war. There's a lot. And I think I even forgot to say inflation, which is the biggest thing out there. So at this moment, there's a lot of uncertainty. But remember, for long-term values, uncertainty is your friend. It creates the opportunity of a little bit of market chaos for you to buy the proper shares that you can hold on to for the long term. So any investor here that holds through this or even buys into a little bit of this market, I don't think they're going to regret it a couple of years out. It's hard to say in the near term, but I think you'll be happy with the way things progress 2 to 3 years from now for sure. With that said, I just want to thank everybody for attending this webinar and for being a client and sticking through some of the most turbulent, rocky moments ever in the history of the stock and the bond market. If you have further questions, please feel free to email or call me, and we can set up a one-off review of your own situation. Thanks, and have a great day.